Hi there, and welcome back to another episode of The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts. It's brought to you by Livewire Markets. I'm James Marley, and in the last episode, we heard from PIMCO's Adam Bowe about the state of the Australian economy and how the combination of rising cost of living and interest rate hikes are taking a toll on many Australians. The focus of today's chat is fully franked dividends, a prized feature of the Australian share market and a staple diet for many self-funded retirees. But the usually generous servings of dividends from the ASX are dwindling, with dividend per share estimates at levels last experienced during the GFC and more recently in the COVID-19 pandemic. So, to help us diagnose the curious case of the disappearing dividends on the ASX, I'm joined today by Dr. Don Hamson, Principal and Chief Investment Officer of Plato Investment Management and one of Australia's leading experts on the topic of dividends. Now, if you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. If you're not a Livewire subscriber yet, head on over to livewiremarkets.com. It's free, easy to register. You'll get access to insights from the leading investment minds in the country. Don, the disappearing dividends, are we going to find a cure today?
I'm not sure we're going to find a cure, but hopefully we can shed some light on it.
Okay, well, it's great to have you back in on the rules of investing, and thanks for making some time today.
No problems. Glad to be here.
So as I mentioned, inflation's been a problem, but it's starting to come down. Rates have stabilised. What does this picture mean for corporate earnings and dividends?
Well, first I'll say, look, it's come down a long way. Inflation peaked at 7.8% in December 2022. So we're looking at, 3.6%. It's more than halved. And the RBA's range is 2 to 3. So we're actually not that far away from where they want it to be, but it's probably a bit stickier than they thought. My personal view, and I'm not an economist, but my personal view is that probably rates are about as high as they're going to get, because you mentioned in your introduction, there's a lot of people feeling a lot of pain, or a certain part of the proportion. If you've got a mortgage and maybe taken it out in the last few years, or even worse, a renter, I was talking to someone yesterday and they were like, the landlord wanted to put the rent up 33%. That's a hell of a hit into your budget. So there's a lot of people doing it tough, but I'll also say there's quite a few people that are doing it reasonably well. A lot of my clients tend to be retirees, and the good side, not the bad side, is asset prices are pretty high. Share prices are close to if not at their peak. Interest rates are higher, which means if you actually have paid off your mortgage and you've got a bit of spare cash in the bank, or in fact might be a large bit for a retiree, you're actually getting much better income on that. So they're feeling happier. So the share price is up, so their investments are up, their value of their superannuation is up, and if they got some extra cash, they're getting more money on it. They are actually spending as much or more. In fact, they're spending more than they used to. But it's the younger people particularly, and you look at the CBA's analysis, people under 35 are feeling it really tough because they've got the mortgage pain and the rental pain, but older people are doing better. So it's a bit of a bifurcated economy.
The other part of my question was just around corporate earnings and the environment with, this higher rate picture.
Yeah. So if you look at where I think the real pain in the economy is, and we are seeing bankruptcies and liquidations and that stuff, it's property, developers and builders who they're being hit by the higher inflation, and sometimes they've had fixed costs building out things, etc. And it's also consumer discretionary in particular, but it's not really a listed market. It's more the unlisted market. It's small businesses.
Main Street sort of stuff?
Yeah, like a cafe in Melbourne or Sydney. We still haven't recovered from COVID because on Mondays and Fridays, I don't have to queue to get a coffee in the CBD because there's nobody there. Tuesday, Wednesday, Thursday, it's a lot busier, but that means you've got to run your coffee shop. You got to make all the money in 3 days, not 5 days. It's much better in the burbs, but in the city it's there. And restaurants are starting to get empty, and because if you haven't got the dough to, or you're paying all your money is going to a mortgage repayment or extra rent, you're not going to go out as much because that's pretty expensive and the prices have been going up. So the restaurants are particularly, I think, finding it tough, and most of those are not listed, and I wouldn't call Domino's a restaurant.
Yeah, it was interesting. I saw someone put up a post the other day or shared an insight that even Justin Hem's restaurants, the Merivale Group, had put 20% discount across all their foods on their pretty top-end sort of restaurants.
Well, they are top end, but even top end, I mean, there are it's not just old guys like me that are going there. It's a lot of younger people go there, and they're being hit by the very big mortgages in particularly in Sydney, and Sydney and Melbourne, or recently even Brisbane, have got pretty big mortgages because Brisbane's now got the second most expensive property in Australia. Well, I'm not saying it's not doing. Some people are doing it really tough, and it is hitting certain parts of the economy, but it's not hitting the banks yet. Banks have got very low bad debts, virtually all-time lows, because they've been only lending to people who had very high quality and were able to satisfy the buffers of interest rates. They're not seeing a lot of delinquencies or bad debts, and so their profit's still okay. It's not growing very much, but it's probably peaked, but it's not falling dramatically. We'll come back to the topic, which is the falling dividends. If you look at it, the main culprits are the resource sector.
Yep.
The commodities. It's the BHP, which 2 years in a row has cut its dividends. Woodside, because oil prices are down. The nickel miners, the lithium miners, where those prices are off significantly. Up until now, Rio and Fortescue actually increased dividends in February this year, but they're probably going to fall in the next ones because iron ore prices have come off 130, and they're still above 100, but they're not much more. So it's the resource sectors which, and previously I've said, the reality is that is quite cyclical, and look, they make their money by selling resources. If the prices of commodities are down, they're going to make less money. They make less money, they'll pay less dividends. So I'm not surprised, but the rest of the market's holding up relatively well because it's not represented by the sectors doing tough, like cafes, restaurants, etc.
So we're going to come to dividends. We're going to go right into dividends. But before we get there, I guess on that point there, you talked about the cafes and those types of businesses doing it tough. From here, where do you think things go for the economy, and is there a knock-on effect to the types of companies that are paying dividends on the ASX, or do you think that those companies and sectors, aside from the miners that you've already mentioned, remain relatively resilient?
Well, so far, touch wood, the listed consumer discretionary stocks have largely actually exceeded expectations because people thought they'd absolutely get smashed. The JB Hi-Fis, the
Nick Scali's,
the super retail groups, Harvey Norman's. And look, their earnings are off a little bit, their sales are off a little bit, but a lot less than what people thought. So it is starting to crimp them, but and there are always positive signs. I mean, the new Apple phone is going to have AI, and I haven't changed my Apple phone for a few years, but I reckon if it's got some great new features, I probably will stump up and buy a new one.
We all need a bit of AI, Don. Even though a little assistant on the side for you.
It can always help. Although if all it does is increase, your CV's written better, but actually you can't change the your academic qualifications or your history. It just makes it read better. So I don't actually. Some of the benefits of AI are actually, I think, going to be very short-lived.
Yeah. We've talked about the rising interest rate environment. Fixed income is getting a lot more interest on the back of those rates. And in some cases, the returns in fixed income are really juicy. Does the case for dividends being the backbone of an Aussie income portfolio still stack up?
Well, I think, for finally, after many years, you can get some sort of return out of those vehicles. But the ones that are really juicy, they're not risk-free. They're credit vehicles, etc. And I paint the worst case scenario is, let's say the RBA does actually start to raise rates 1 or 2 or 3 more times, and then we have, we're close to zero growth at the moment. The latest quarter was 0.1%. Annual growth rate was only 1.1. You need to have two negative quarters, but we're only, a very small way above that 0.1%. The worst case scenario is if the RBA has a bit of a brain freeze and does, say, 3 rate rises, then I think Australia could tip into a recession. I don't think that's not my central view. My central view is they probably sit on their hands and do nothing and try and jawbone inflation out of the system. I don't think they'll lower rates till next year. But, there's still that slight potential. And if that's the case and people start to lose their jobs big time, then you will have defaults, you will have delinquencies and those sort of things. But at the moment, we still have largely full employment. House prices are going up, so you're not seeing too many problems. But private credit can have, is cyclical, and it's cyclical with a lag. The bad debts follow the cycle. So I'm not saying don't invest in those things. You can get some decent income, but it is not risk free.
Mm-hmm.
And you want to go with the good operators, not the Johnny-come-latelys.
Yeah. Don, as I mentioned in the introduction, there is a bit of a case of the disappearing or dwindling dividends. The payout ratio for companies, based on some research from Commsec, is at near decade lows, 62% compared with 72% prior to the COVID-19 pandemic. And the actual total, the dividend yield of the market is below its historical average, I believe. It's just under 4% or around 4%.
Well, that's what's the thing about dividend yield, though? It's purely the dividends paid in the last 12 months divided by the current share price. And one of the reasons the yield's low is because share prices have gone up quite a bit in the last year or so, particularly for like the banks. The banks have rallied significantly. And so Commbank's yield is now lower than I think I ever remember. I would say one thing, for us in particular, but I think for most Australian investors, is you should also include franking in that. And, franking's worth, well, it's not worth as much as it was, but it puts that at about, low fives rather than just under 4. So franking credits are valuable, particularly for retirees, but all Australian residents get them. You get a credit for those imputation credits, so you shouldn't discount them. And I think you need to add them back when you're doing comparison, because you don't get any tax credits with fixed income or floating income.
Yep. But those observations, that consistent with what you're seeing in the market? What are your forward expectations around payout levels? Why are payout levels dropping? What are the implications for future dividends?
Yeah, well, as I said, one of the read-throughs is that one of the reasons why dividends are dropping, we don't tend to look as much at payout ratios, but more at just absolute dividend levels. And yeah, like the dividends peaked 2 years ago. But if you look at the chart you have, or the residents haven't got it, but like this fall in dividends has followed 2 incredible years of very big dividends, so dividends went sort of above trend, and now they're sort of coming back. So the dollar value of dividends coming out of the Australian market is still pretty good. Slightly less than it was last year. It's still pretty good. The yield's gone down because share prices have gone up. And I think we're all happy to have share prices go up. I mean, you don't really want to say, well, let's have a high dividend yield, because let's let the market fall 33%. I think we'll be pretty unhappy with that.
So the total return remains okay?
Yeah, for a lot of companies anyway. That's right. Yeah, look at the banks. Their total returns have been good the last 12 months.
A big contributor to that fall, as you have already mentioned, was declining dividends from mining companies. Now, you were really early to embrace these stocks. How do you see them going forward? You publish a mix of the biggest dividend payers from the ASX 200, and it's often the banks and a couple of miners that pay out more than 50% of the dividends from the ASX 200. So if the miners are struggling, how does that impact your portfolio?
Well, it is the case that it's still the case that the banks and the miners are still the top 6 or 7 dividends and represent more than 50% of all the income is basically 4 banks and 3 or 4 resource companies, and which is a little bit frightening. But clearly the resource companies of a couple of years ago were actually BHP and I think Fortescue were bigger than the banks. And now what's happening, and it's also been reflected in the share price, is that BHP... last time I looked was just bigger than CBA, but CBA's almost caught up because BHP's dividends are falling. And part of that problem is it's written it in the last 12 months, it wrote its nickel assets down to nothing. In fact, it wrote it down to a negative number because it said we're going to have to restitute, we're going to spend $300-400 million to clean up the place. And so we've actually written it down to minus $300 million US. But that's cyclical and things can change. And, the reason why nickel prices are down is because China has helped finance some big nickel mines in Indonesia. They pumped out massive supply, but those mines are some of the dirtiest mines around. And so if we start to put a cost on pollution, you might be penalising those. And so maybe there might be, cleaner nickel might trade at a better price. Who knows? Iron ore price goes up and down. Lithium, lithium miners, which we don't own now, but we used to own only a year ago. That's fallen out because EV sales have disappointed. And Tesla's cutting the price of its vehicles, and it's got 2,000 sitting unmarketed, etc. But that can change around as we get more charging stations, etc. I mean, I think longer term, EVs are still the way to go. It's just going to be a bit longer than what people think. You got to keep watching this space. And I think I said last time, you're getting good dividends out of. Last time we did this a year or two back, you're getting great dividends out of mining stocks, but you've always got to be very cognizant of what commodity prices are doing. So what we do, and we're very active, and we rotate our portfolio to where the dividends are. You're getting some good dividends, still good dividends out of the banks. Westpac paid a special. CBA actually increased its payout ratio, so it might have gone against the market's norm. Insurers have been increasing their profits strongly and increasing their dividends. QBE increased its profits by 100%. I think its dividends by 60%, the latest result. We quite like the insurers because they are benefiting from higher interest rates because you pay in the premium and they put it in cash or in short-term fixed income and they invest some money on it. The other thing is, every time you open up an insurance premium, it's 20% or 30%.
I was about to say, investing in the insurers is probably a good way to kind of offset some of those premium increases. It's been insane.
Yeah, exactly. And that's how you can sort of hedge your portfolio is own some of the insurers because you'll benefit from, even though you're going to pay extra on the premium, if you own an insurance company, you'll benefit from their increased profitability.
Is there a pick of the insurers from a dividend perspective?
Look, I don't like to focus on stocks, but generally as a sector, we like pretty much all of them.
Yep. Okay.
And remember, we rotate through them, so we probably pick up 2 or 3.
What are some of the tactics that you've talked about rotating, but to sort of combat that declining dividend backdrop? Do you need to become more concentrated, or do you look to become more diversified in where you're searching for your yield?
Well, I think you need to become more active, as in even rotating even harder if yields are lower, and really moving the portfolio around to whether it be insurers or where you see those dividends. So you probably got to be even more active, and we trade our portfolio about 150% a year. We might even have to increase that. I always think diversification is the only free lunch in town in terms of finance. I used to be a finance professor, etc. So we are very against get very concentrated and put everything eggs in one basket. Might be answering a question that you were going to ask before later on, but if I look at this sort of thing, we like the insurers, and like a year, probably 18 months ago, we were overweight Medibank Private, and then bang, out of complete blue, cybersecurity issue, share price is down like 20% in a week or so. Our portfolio got hit by that. If we only had 20 stocks in the portfolio, we would have probably lost a percent on the whole portfolio just from being overweight Medibank Private. But we own about 90 stocks, and it didn't have a big impact on the portfolio, even though we were overweight. And as it's turned out, it did rebound, and it did bounce back anyway. But the reality is things come out of left field, and if started last year, it was what were the economists saying? They were saying interest rates are going up, and they did go up. The mortgage cliff is going to happen. All these people, there's a lot of people on low rate fixed interest loans. They're going to roll off in July, August, September. They're not going to be able to make the repayments. There's going to be a huge round of defaults. The banks are going to have massive bad debts. What has happened in the last 6 months? The banks have rallied 20 or 30%. There's been no bad sign of these bad debts. Some are starting to come through on non-bank lenders, but on the banks themselves, very good. So no matter how much work you can do, it might be a left field thing, or it might be you got part of the top down right. Interest rates have been rising, but you got the second bit wrong. There was no defaults. Well, partly why there are no defaults is that people do cut back on their the Wagyu and Shiraz. And you're seeing that in Endeavour Wines. People are trading down to cheaper wines. People are not buying top quality meat, or they're not going out as much as I mentioned before, because they're going to pay the mortgage in Australia. You can't just hand the keys back. But also, if your house price is up 10%, you probably don't want to lose it. And and maybe you go get a second job, or you drive an Uber. It's never been easier with the gig economy these days. So people are muddling through, but a lot of people are cutting back on those consumer discretionary items.
Yeah. Do you think the banks, I guess, I think even to my own experience, refinancing a mortgage or, taking out a new mortgage, the hoops that you have to jump through, even 18 months ago, 24 months ago, they're quite significant. The amount they were lending out declined. Your ability to borrow declined quite significantly as interest rates went up as well. If we could see that the interest rate rises were coming, it was going to cause some pressure. Surely the banks were planning for it.
Well, I think they sort of have been planning for it, and APRA has been one of the reasons why it's tougher these days is that there's a lot of more regulation on banks than there was, 10, 15 years ago, and you do 3% interest rate rise stress tests and those sorts of things. So I think that's a testament to the system is we haven't seen a lot of bad debts given what's happened in the cycle.
It's the flip side to why people lament the lack of growth in the banks is because, they're more secure and more stable.
Yeah, and so that's a positive, but I would say they look pretty expensive. So I'm much happier to be rotating through banks to get dividends and be like, say, just all overweight banks. They've had a great run last 6 months, but I think it's hard to see their share prices continuing to go up. They're definitely expensive. Although I would say it's not just an Australian thing. Banks around the world have rallied similar sorts of levels over that same sort of period. I think as people have realised that we're pretty much at the end of the interest rate cycle, and look at the moment, ECB and Bank of Canada have actually cut rates. So normally it's the US which is leading it. They haven't yet, but we've got 2 countries now starting to reduce rates. I think probably my view the next move here is down, not as much on the US. So hopefully things will get better.
Yep. Don, you did touch on it a little bit, but your Aussie portfolio, your Australian fund can own in excess of 100 stocks. Is that simply the diversification so that you don't get impacted too much by a surprise in an individual stock, and you're trying to provide that really stable return for investors?
Well, it's a couple of reasons. One is that, diversification is a free lunch. So if you're very concentrated, you can get smacked around by something unforeseen like the cybersecurity issue. The other thing is, and you mentioned about you got to be more selective, focusing on stocks with dividends. Well, I'd say actually you've got to be more. You got to often seek out even smaller cap stocks that might have quite decent yields, still have decent yields. They may not have rallied as much, and so that's one reason to have a broader sort of holding of stocks go down. It's not just the big stocks that we get dividends from. There's some juicy stocks in some of the smaller retails and in many areas, quite a few stocks there that we would go into that like a Dalrymple Bay or something like that, which is quite small.
What are some of the lesser known names, maybe some small caps that you would call out as good dividend payers? You mentioned there Dalrymple Bay. I hadn't even heard of that company before.
Exactly, right? And so that's our job, is to try and find these sort of smaller diamonds. And so there are a few around. I mean, but this is the thing, you're not going to put 5% of your holding. I wouldn't put 5% of my holding in that sort of stock. So the smaller they are, less liquid they are, you got to put smaller amounts of, money. If you're a big liquid bank or resource company, you can get in and out of that thing pretty quickly. And if your views on commodities change, you can get out. So it's a port actually, so it charges, so.
Yep.
So it's quite a reasonably stable one, although some people sort of think that this sort of commodities it deals in might no longer be here eventually, but I think they're going to be here for longer than people think.
Is it coal port, is it?
And gas, yeah.
Yeah.
So,
yeah. Are there any other examples at that smaller end that you can talk to?
Look, there are. I mean, we're always a bit coy on talking about our stocks because we like to, do want to get our IP. You buy a fund. We're not here to give too many stock tips. The other thing, which I got from another manager, is look, we can have very quite short term views on a stock. So we might buy for the dividend for 2 months and then we'll sell it completely.
Yep.
And we don't want people to think, oh, it's a great stock forever, and because things can change. And so, yeah, I'm a bit loath to provide names. Probably shouldn't even mention that one, but it's understand the risks involved as well.
Don, you talked earlier about the insurers being attractive. Something you've talked about in the past is winning by avoiding the losers. So what are you avoiding in the portfolio right now?
Well, lithium miners. So we were overweight a year or so back, but clearly lithium prices have fallen a long way. And at the moment, it's a struggle. Now, that can change fairly quickly if we see EV sales come back up. It might go, but the Pilbara Minerals didn't pay a dividend at all. Paid a pretty good dividend 12 months ago. So we're avoiding some of the beaten up miners because until their commodity prices start to pick back up again, they're not going to make money. REITs, and particularly office-focused REITs, we think they're still pretty tough. The other thing I'll say about REITs, and this is why you need the franking, is they have franking. And you might look at their cash yields on those, and they might look reasonable. But remember that if you've got a fully franked dividend at the same cash level, to me, it's actually worth quite a bit more, about 40% more, particularly for retirees.
Yep.
Franking credits are important, and there's no franking there. And we still don't like sort of a lot of the tech areas. Australia hasn't got that many tech stocks, but we still think there are some overvalued ones that are paying pretty miserable, if any, dividends. So those are sort of areas where we're definitely underweight IT, we're underweight REITs as a group, and we're underweight lithium miners.
I imagine those IT stocks are probably also quite vulnerable to large share price moves.
They are, but it can go both ways. And if you look at 2022, a lot of them fell a hell of a long way. It was a value market, and those stocks were on very high PEs, and so many of them not actually delivering that much cash earnings. If you look back to last year, they all seem to get incredibly boosted by almost by definition, they're in technology, they're AI related. Well, a lot of them aren't really AI related in Australia, that's for sure. And so I'm not sure there's as much of a flow through. I mean, a couple of the stocks that, I actually think one of the better stocks to play AI in Australia is, but again, it's, maybe it's just flavour of the month, and Nvidia's down for the last few days quite heavily. But Goodman Group have called it right, first with distribution centres and more recently with data centres. And they got great they got their feet on a lot of sites and power to be able to continue to develop those centres. And they're more like a developer than actually a REIT. Actually, it's been a great REIT, a great company really almost, but it's not on a high yield. But they're quite profitable, and they are growing strongly.
Maybe a couple of years ago, the yield that you were targeting or able to achieve out of PL8 was close to double digits. It might have been even in double digits with the franking added in. What sort of returns, we talked about this disappearing dividend environment, but you still sound pretty constructive. What sort of returns do you think are realistic for you?
Yeah, so historically, the underlying investments of PL8 have delivered over 9% gross yield after fees. And but market yields were grossed up or close to 6% historically. Market's risen quite a lot recently, and you've seen resources paying out less dividends, so you've actually got paid out a bit less, and the price is high, and though the yield has reduced to gross a bit over 5. So we think we're currently getting around 8.6% out of the underlying fund compared to our normal 9%, but we're still doing 3%, more than 3% above what the market is yielding. So probably more the mid 8s the next 12 months. Because remember, we rotate aggressively and may have to be more aggressive to get those sorts of things. Now, having said that, that is the yield of, in fact, the underlying fund that PL8 invests into. PL8 itself is still trading at about a 10 to 12%. In fact, last time I calculated it today, it was 12% premium to its NTA, which actually means that even though it's getting 8.5 in, but because its price is 12% higher, it's actually going to be 12% less yield. So it's a bit under that, but it's still well above the market.
What do you put that down to? Why does that 12% difference exist between the listed vehicle and the unlisted vehicle?
We do ask ourselves that question, but look, they aren't exactly the same animal, even though they have the same investments. So their investments are generating the same yield. PL8 is a listed company, and so its share price is determined by supply and demand. Supply is fixed. We're not issuing shares. We have issued shares, but haven't issued any shares this year. There's no such thing as a dividend reinvestment plan or anything like that. So there's no new shares being issued. So demand must be higher than supply. Supply is zero, so there's still excess demand for it. It is the only listed investment company that pays a monthly fully franked dividend. I think it's the only investment company that pays dividend monthly. So it's a bit unique in that, and the fund does not pay monthly; it pays quarterly. So if you're and a lot of the focus of this is retirees or people who want to live off their income. If you're retired, you no longer receive a monthly salary, but you can get a monthly payment out of PL8. So it's pretty unique in that. So there are a few credit vehicles that pay monthly, if you like, interest, but they don't have the franking. So in the listed equity market, it is very unique.
Yeah, scarce, therefore a premium. Very good. Well, let's get into our three regular questions. We ask these on every podcast. First one, Don. Could you share a story about a big win or a big loss? What happened and what did you learn?
Well, I sort of answered this before because I was going to say Medibank Private. Like, okay, we'd done the work and it came out of left field, the cybersecurity thing. First thing is, it just, I think, reinforced our view that you need a diversified portfolio because we could not have known about that. No one really could have known. Even the company itself didn't know. We didn't know at the time. Maybe we should, though, that they didn't have cybersecurity insurance. But how much that would have.
A new thing on the checklist.
Another red flag or a question to ask, etc. But as I said, the outcome was it didn't really affect our portfolio. So it's sort of a tick to our process that you should be well diversified. But maybe you should ask another question. I think it just reinforces that thing because there is a view out there, I think, that you should back your conviction and just buy the best 10 or 20 stocks that you have. But then you got 5%. If you buy 20 stocks, each position's 5% of your portfolio. Medibank Private went down like 20, 30%. 20% of 5% is 1%. You've lost 1% bang there on that one thing. And it's not even like, Setire, the little retailer, dropped 50% on an announcement. And say 5% in that, it would be 2.5% hit to your portfolio. That's hard to get back.
So how big would be the biggest position in one of your Australian share funds?
Well, we do have bigger positions in the more liquid stocks that you move in and out again, and also in stocks where it may be we're overweight one bank and underweight another bank. So we're not actually overweight the banking sector, so we're not taking a position on banks, but actually we like,
one bank relative to the other.
Relative to another one in the same industry. So often if there's a shock to that sector, it's going to affect all banks together. And if you are in what you think's the best bank, then it's not as big a bet as just having a massive position in one single stock or industry.
Yep. Are they?
We're talking like 3 or 4% positions.
Yep.
We always look at it relative to the index as well. So we're looking at being up to 3%, 3 or 4% overweight in those very large liquid stocks, or 3% underweight.
Yep. Don, what do you think investors are getting wrong about markets right now?
If I knew, then that might be a good thing. I think that's hard to tell. But what I will answer a slightly different question, but it's sort of, when I go around the countryside and I see a lot of clients, one of the most asked questions I get at the moment is, US election, what's that going to be? How's that going to, isn't it, Trump's going to win, isn't he? It's going to be disastrous for markets. So there's a huge fixation on the US elections. Looks like Trump's probably going to get in, I think. But
last time that was good for markets.
Exactly. That's my answer. Everyone's like worried that Trump's going to get in and okay, he's a bit of a loose cannon and now been convicted. But he wasn't that bad for markets last time. In fact, some of his tax policies, I think, were quite good. And, the President of the United States is not all powerful. There is Congress and Senate, and, it's actually often tough for them to do that much. So he says a lot of stupid things. He's, I think a lot of Australians, a lot of people outside of the US scratch their head as to how he could ever become president of the US. I think I scratched my head as like, how can Biden and Trump be the
best candidates?
Best candidates in, arguably the greatest country in the world. There's a huge number of smart Americans, and we're left with.
Well, they're busy off building Nvidia, aren't they?
Well, that's right. They're making money. Well, Trump has made some money in his past. Maybe he's made more than he says he has. But it's there's a lot of focus on it. But I actually don't think it's going to move markets all that much. I mean, we actually do stress our portfolios for, whether Biden wins or Trump wins, what it might mean. It doesn't move the dial that much. So I'd be more worried about, if the Middle Eastern crisis, sort of gets bigger and involves other countries, and we do see oil prices rising. But so far, we touch wood, you haven't really seen oil prices rise at all out of that sort of stuff. But that would be, to me, much more important than who wins the election.
Yep. All right, then we're going to wrap it up. This is the final question. Which stock outside the major banks and miners do you think is most likely to be a 5-year resident in the Plato Australian Shares Income Fund?
Yeah, well, maybe I didn't read that question well enough because my answer is Origin, because it's sort of not really classified as mine, as a bit of a utility. It has got gas though, and so that gas is doing well. But also, it's doing better on the electricity generation, and it's a distributor as well. And the reality is, we all need power, but I think also we all need gas, and they've got gas things. So they've had their tough times, but I think it's going to do pretty well for the next 5 years.
Could you dig just a bit more, just explain a little bit more about the thesis behind it?
Well, another thing is that they recently had hearing their power station the life is going to be extended, and it's going to be underwritten by the government, etc. And we think that will be quite profitable for them. They probably will. I don't think the government's going to have to pay them any money for that, because I think they're going to make a lot of money out of it. The reality is the movement to, having green energy replace, coal-fired power stations taking a lot longer than you think. And, every time somebody does close a power station down, electricity prices go up. And we have seen that. And so now both AGL and Origin are actually back to being reasonably profitable. And we don't see that changing. And the extension of that coal power station will, I think, boost its earnings. Gas, I think, is quite a good transition. So to me, it stacks up pretty well. And, clearly, I know there's now talk of uranium and other things, but like they're a long way off.
Out of the picture, aren't they?
Yeah, they're not going to affect 5 or probably 10-year type things if they ever happen, because I struggle to see how if we're struggling to get a wind farm. They're investing in wind farms and EVs where it makes sense as well, but not EVs, batteries and things. But I think the technology of uranium is great, but I just think if we can't get a new offshore wind farm up and running, how are we ever going to get a nuclear power plant? That get the approvals and etc. I think it's going to be extremely difficult.
Yep. Great. Well, Don, as always, we love having you on the Rules of Investing. Our audience love hearing about the outlook for fully franked dividends. It's probably, as I mentioned in the introduction, it's a staple diet of their portfolios. So thanks very much for coming in today.
Thank you.
For all you listeners out there, remember, hit subscribe on your favourite podcast platform or check out the podcast on YouTube. We're adding fresh content like this every week.